Okay, so let's set some expectations before we start on lease accounting. So I know sometimes when you hear speakers speak on a topic, they'll say, hey, we're just going to raise awareness and we're going to go top level and just make you aware of some concepts. And that's not what this is going to be. Okay, we're going to go down and take a little bit of deeper dive into lease accounting because as you heard Wayne say at the onset, it's time. Lease accounting is up for private companies and nonprofits now. This can has been kicked down the road a couple times, partially due to COVID, but it's time now. This is the year, 2022, that you'll have to implement it. So we are going to go through an example at the end here. So we are going to be taking a little bit of a deeper dive into the topic. So you have that to look forward to. And then also, please ask questions. I think you could tell by now we're a fairly informal group. So as we work through the program, any question at any time is fair game. Lease accounting is relatively new. And so I don't know that there is an expert in lease accounting yet. So we're all kind of learning this stuff together. So questions are always welcome. So to start off with, it's hard to believe, but this lease standard, and you're going to hear folks reference ASC topic 842. That's the codification of where the lease guidance is. So we lovingly call it 842. So when we say 842, that means lease accounting. This new standard was issued 6 years ago. So it's been with us for 6 years. And again, private companies and nonprofits are just now getting around to implementing it. So that should tell you a little bit about the magnitude of it and maybe some of the complexities of it that, again, we had 6 years to implement this thing, which is a very long time. Since it's been issued, there's already been 8 amendments. 8 amendments. That's not unusual for standard setters to issue a new standard and then come out with amendments because they realize they didn't get everything right or there was maybe some things in the standard that weren't real clear. So it's fairly common. The takeaway for all of you on that is when you learn something, whether it's lease accounting or contributions or revenues, you can't just set it and forget it. Things change, accounting rules evolve, they make tweaks. So you've always got to stay on top of this stuff. And one of the things we will try to do for you, if you're a client and you're a friend of the firm, we do try to keep you current too. So we always try to allot some time with our clients to make sure that we're keeping you abreast of what's new. And so we'll continue to do that. The nice thing about the lease standard and really the way standard setting in the United States works, usually it's the public companies that have to go first. They're kind of our guinea pigs, right? So whenever there's a new accounting standard, we always have the public companies do it first. And then usually the private companies and the nonprofits follow maybe 1 or 2 years later. So truthfully, we've already seen this lease accounting standard in action. And since our firm, we actually work with public companies, we've actually implemented the standard with some of our clients. So we're not really recreating the wheel here. We've got some lessons that we've learned already. If you believe in the adage, start with the end in mind, this is kind of the end. This is just a little snip, and you probably can't read it too well, but this is a snip of Amazon's most recent balance sheet. So Amazon is a public company. They filed their 10K in February. Their 10K has their financials in it. And this is what their financial statements look like. And you can see there's a very material asset on their balance sheet called operating leases. And it says $56,082, but those are actually in millions. So it's actually $56 billion of operating leases they have on their balance sheet. Just from a magnitude standpoint, that's 13% of their assets. So it's a material number. It's 13% of their total assets. And then, of course, they'll have an offsetting lease liability there as well. But that's really what this lease standard is all about. It's about putting that operating lease onto your balance sheet. You have an asset and you have a liability. And that's very different from the world we were living in before. So what I'd like to do now is just go through some real basic concepts that are in the standard. And the first thing to ask is, why are we even doing this? What was wrong with the old model? Why do we have 842, and what problem is it trying to solve? One is international convergence. If you've been to accounting seminars, you've heard US GAAP is converging with international standards. This is a process that started long ago. It's still in process. But what we're doing is we're narrowing the gap between what international standards say and what US GAAP says. And so those two roads continue to narrow. And that's part of this standard too. So this standard is very similar to the sister standard in international standards. Okay, so again, it's about bringing the two sets of standards together around the world. And then also, this is another more evidence of a shift towards more principles-based accounting. If you remember the old accounting rules we had under 840, and you had to figure out, okay, is this a capital lease or is this an operating lease? And they gave us a 75% test and a 90%, and everything was very rigid, very mechanical. We're not doing that anymore. We're moving towards a principles-based approach. So the standards are going to give us concepts, and then it's up to us to apply those principles and try to come up with the right answer. The other thing that this is responding to is the investment community. The investment community was forced to analyze companies. And what if you had, for example, an airline company, and one airline company had a belief that they were going to lease all their airplanes? And maybe another airline company said, no, we believe that we're going to buy them all. And so you're comparing those two financials. They're going to be very different. The assets are going to look different. Liabilities are going to look different. The one that's leasing it, you're going to have to go dig in the footnotes, figure out what the lease table is, what are they paying, what's the expense on them, what's the length of the lease. So some of this was really just to facilitate better comparisons in financial statements. So we're telling everybody, hey, all these leases are going on the balance sheet. We're going to put everybody on equal footing, and it's going to allow the investment community to do some better comparisons and some better analysis. As we said here, in the second bullet point, again, this is all about onboarding those assets. You saw Amazon.com, they call it an operating lease asset. A lot of companies are using the term ROU asset. ROU stands for right of use, because when you lease an asset, that's what you have. You have the right to use it. So some companies call it an ROU. And then, of course, lease liabilities. We do have an exception that's in the standard if you have a lease that's 12 months or less. So maybe you say, boy, if it's only a 12-month lease, do I have to really put on my balance sheet and then amortize it over 12 months? It's kind of short. And the answer is you may not have to. There's a scope exception. So this is a practical expedient that says, hey, if it's a 12-month lease, you might be able just to go ahead and expense it as you make the payments. So there's a little bit of an out there. What's interesting is, as we just saw the Amazon balance sheet and a big change in the balance sheet, what's interesting when we're onboarding these operating leases, the income statement, not so much of an event on the income statement. And the truth is, your income statement and how you're running the lease expenses, it's not going to change. And so you think, wow, we got this big old asset and this big old liability, but the income statement is going to stay the same under 842. And so we'll walk through an example and we'll actually show you that, but that's true. That's true. It's just that now we have an asset that we're going to amortize, and that's going to hit our lease expense. We had this lease liability that's recorded at a present value number, so we have to accrete that into interest expense. So we have a little bit of interest expense from that. We have a little bit of amortization expense from the asset, but together they're going to equal the old operating lease expense that we had. The standard says that we have to implement this thing using a modified retrospective approach. So all that means is, again, if you're preparing 2 years of financials, normally in your GAAP set of financials, maybe 2 years, we call those comparative statements. So all that means is you're going to go back to the beginning of the first year presented. So if you're 12/31, say 2022, and we've got to implement the lease standard, what we're going to do is go back to the first day of the first period. So we're going to go all the way back to January 1 of 2021, implement it on that day. That way, when we have two comparative statements, it's going to be apples and apples. We'll have 842 in both balance sheets and on both income statements. Everything will be nice and clean. So we call that modified retrospective method. Okay, so those are just some basic concepts that are in 842. This slide has some of the more difficult concepts that are in 842. One thing I want you to feel confident with 842. It's honestly not that hard of a standard to implement. And I think when you leave here today, I'd like you all to be feeling good about it. And I think after we go through the example, you will. But I want you to balance that with having a little bit of respect for the standard, because there's some nuance in it. And there's a lot of nuance in it. And like most things in life, the devil's in the details. Just to give you a sense, the big four firms, they're really good about putting guides out when a new revenue rec comes out or a new lease accounting standard comes out. They write these beautiful guides that really dissect the standard. The Ernst & Young guide on lease accounting is like 500 pages long. There's that much to write about. Probably didn't need to be that long, but maybe they got paid by the page. But again, the devil's in the details here. So here's some of the more complicated things that are in the standard. One thing to be aware of is leases sometimes hide in other contracts. And the standard calls those embedded leases. Okay, a simple example you might even have at home. You might be renting. You might be paying for internet service, right? And maybe your Cox provider gave you a modem. Maybe they gave you a router, and they say, "Hey, pay us $100 a month. We'll provide you with free internet, or provide you with the internet service." So in that case, okay, you've got the internet service, but you have a modem and a router from them. Are you leasing that from them? Is that really an embedded lease? Maybe you have an arrangement with a data center, and the data center provides you with X computing power every month. And so they're providing you that service, but is there a lease embedded in there? Do they have a server that's dedicated to you and running your stuff? And is that really a server you're leasing from them, or is that a service contract? So the warning there is leases can be embedded in other contracts. So that's just an awareness thing. There's a lot of accounting policy elections in this standard. One good example is a discount rate. So we're going to be using discount rates to present value back our lease payments. So the standard gives us a nice accounting election that says, hey, if we don't know what our incremental borrowing rate is, or if that's too difficult to determine, I'll tell you what, just use the risk-free interest rate. And that's an accounting policy election you can make. You can just use the risk-free interest rate, look up some treasury yields, and then you're set. That's a nice accommodation. We have lots of disclosure requirements in 842. Those are all detailed out in the standard. Related party leases require special attention. What we're doing with the related party leases in the standard is we're just using the contractual terms, whatever's enforceable, whatever's written in the contract. So even if you have a sweetheart lease where maybe it's below market because it's a related party, we're just going to go ahead and account for it based on the enforceable rights that are in that contract. And I think that's really all I want to say on this slide. Again, the slides are going to be in your program, so you can kind of read those at your leisure. Maybe the last comment on this page would be, just remember, it's lease accounting, and yeah, it's going to affect your books and records, but this is going to permeate throughout your organization. So, who's signing the leases, who's negotiating them? Are you going to change your strategy knowing that everything's going to be onboarded now versus the old days when they were just buried in the footnote? What's it going to do to ratios? We have some banking friends in the crowd here. Think about, you just saw that example for Amazon, right? We had that big old lease liability. That's all in long term. And the lease liability, some of that's current, some of that's long term. Think what that's going to do to maybe your current ratio or some of those things that you may have covenants on. So it could cause some havoc. So here's some key concepts. Again, before we get to the example, again, some certain things that we need to know. We need to go through some of the concepts in 842 and some definitions. I think part of the reason why Ernst & Young guide was 500 pages is because 842 actually defines what a lease is. So it's going to tell you if your contract looks like this and has these characteristics, it's a lease. And there's two main themes in that. One is there an identified asset? And does the customer have control of that identified asset? So let's use that data center example. So let's say we've contracted with a third party. We've got X trigabytes of processing power at the data center. So is that a lease or is that a service contract? What is that? Well, if the host says, yes, Andy, you have this server. This is the best server in the whole building. It's the fastest. It's the most secure. This is your server. Then odds are that's a lease. It's dedicated. You've identified the asset. You get all the benefits from it. But if it's not that arrangement, and our arrangement says, Andy, I'll give you one of these 1 million servers I have in here, and I'm going to switch it around depending on my power needs and customers that come in the door. So I'll give you X trigabytes, but you know what? I'm going to put you on whatever server suits me. So in that case, there's no identified asset. So maybe that's not a lease. Maybe that's more like a service contract. I'm just providing you a service. Okay, so the first step we have to go through in our contract is figure out, is this a lease or not? Small ticket items in the international standard, it was nice. They said, hey, if something's less than $5,000, don't even worry about it. You don't have to run it through this model. Just keep expensing it as you pay it. Unfortunately, the US standard setters didn't follow on, so there really is no exception for small ticket items. What the standard does let you do is it does let you use a portfolio approach. So let's say we've got 10 photocopiers and we've got 15 automobiles that we're leasing. What we can do instead of doing one by one, we can kind of portfolio those and just say, I'm going to put all my cars in this bucket, I'm going to put all my photocopiers in this bucket, and have a little bit of simplification. So the standard does try to be practical in some places. The concept around non-lease components, this is probably one of the more tricky areas in the standard. So as we all know, sometimes lease contracts have other things in them, right? So if you're leasing an automobile, maybe you get 2 years of free scheduled maintenance, right? If you are renting an office building, maybe you get janitorial services as part of the lease contract. So the standard refers to those things as non-lease components, okay? That's not really related to your lease of the car or the lease of the office facility. These are other services that the vendor's providing you, right? It shouldn't really be part of the lease. But again, practical application comes to the rescue and says, hey, we will let you combine those things, because otherwise what you'd have to do is you'd have to really separate them and say, this is the piece of my payment that relates to the scheduled maintenance, this is the piece of my payment that relates to the car lease, this is what relates to my real estate, this much relates to the janitorial service, and then accounting gets super messy and super complicated. So the standards, again, gave us an accommodation. They said you can bring those things together and account for the total amount. That's kind of nice. One of the biggest shams in 842 is the idea that there are no more capital leases in GAAP. That is not true. We still have capital leases. We're just calling them finance leases now. Okay, so part of 842 is when we enter into a lease, kind of like the old days, is an operating lease a capital lease? We say, is it an operating lease or is it a finance lease? And again, the sham is if you read the requirements for a finance lease, it's almost the same thing as a capital lease. True, they got rid of the 75% and 90%, some of those prescriptive numbers, but they've replaced it with words. And in concepts are still the same. So capital leases really didn't go away. We just call them finance leases now. The important date in your lease contract is not really the inception date. So the date maybe I sign a lease contract. So maybe on January 1 I sign a lease, but maybe I don't expect to move in until the summertime. The inception date doesn't really mean anything on that lease contract. It's all about what we call the commencement date. And the commencement date is the date that you take control. And that's really when you would then say, okay, now I need to measure my lease liability, I need to measure my lease asset on the commencement date. So your takeaway there is that's the important date, not the date you sign your lease contract. Lease term, okay, that sounds really easy, right? So what is the term of your lease? And we need to know that because we're going to do present value calculations and calculate the present value of our lease payments, right? Well, what if your lease contract says, hey, at the end of your 7 years, you can renew this lease contract for another 7 years at the fair market value? Okay, is that a 7-year lease or a 14-year lease now? And of course, the answer is it depends. The standard tells us you have to be reasonably certain to exercise that option to extend. And if you are reasonably certain, then you would, again, include that in your payments. But the threshold is reasonably certain. And again, there's no percentage that we can give you on that. The standard does say that it's a high threshold, higher than probable. So you'd have to be really, really confident that you're going to extend that option period to include the extension period in your lease calculations. One thing that might influence you, what if you spent a couple $1 million on TIs? Spent a couple $1 million on TIs for a 7-year lease, that may not pencil out very well. Over 14 years, yeah, that might pencil out a little bit better. But if you make an investment like that, that might be an indicator that you intend to extend. So that would be a reason maybe you do that. If not, you didn't put any TIs in, what's preventing you from picking up and moving? Nothing. I don't really have an incentive to exercise because it's fair market value. Maybe you don't include it. Okay, but determining the lease term, you can see there's a little bit of art in that.
You're right.
Yes?
If it says after 7 years you're opting is at the fair market value, then how do you know what dollar amount to include as your future payment with the fair market value?
Yeah, that's a good point. And in that case, you would probably just use whatever your last lease term is and just use that over 7 years. That would be the best information you have at the time. Yeah, the standard wouldn't expect you to take out a crystal ball and try to forecast, okay, what is the Orange County rental market going to look like in 7 years and try to forecast future rents. Yeah. That would be fun, though. Lease payments, something like lease payments sounds pretty straightforward, right? So what are my future lease payments? That's what I'm going to discount back. Okay, well, the fixed payments are probably pretty easy, but what if you have some variable payments? What if you're a retailer and you pay 30% of your store sales to the Irvine Company every month? Okay, we call that a variable lease payment. So we would not include that in our lease calculations. If you have a variable rate, maybe because of a CPI increase, that's fairly common, right? How many leases do you read and it says, hey, every year we're going to increase your rate based on the increase in your local CPI? So in that case, we would recognize that, but we would not bump up our lease payments every year for estimated CPI. We don't know what that's going to be in the future. So the standard says, hey, just use today's rate and then just calculate your present value based on that number. When those increases actually happen and you are paying more in rent, just expense that extra piece as you go along. So again, something as simple as lease payments, again, there's a little bit of nuance to it. We talked a little bit about the discount rate. That is the rate when you present value your future lease payments. That's the rate that you're going to use in calculating the present value. The standard says use your incremental borrowing rate. You can make an accounting policy election to use the risk-free rate. Public companies don't get that. Only private companies and nonprofit get extra bonus. So there's your bonus for the day. Good job. And then the last bullet point on this page is just a word about initial direct costs. So if you pay a commission for your lease, you can capitalize that and you can amortize that. You don't expense that all today, right? You capitalize it and you amortize it over the term of the lease. The standard is very picky, though, about what kind of costs you can capitalize. In the old days, you could even capitalize some internal costs. So if you said, hey, my CEO was involved in lease negotiations, spent a lot of time, I could probably allocate even a little bit of his time to that job. This standard is really picky on the capitalization of direct lease costs. Even when it comes down to an attorney, most of you probably have an attorney review your lease. You might or you might not be able to capitalize and amortize those expenses. So you want to look at those really tight because it's pretty strict on this standard. Okay, example time. So now let's apply some of these concepts that we've learned. This is going to be a very simple example, but it'll walk you through some of the journal entries and what you should be thinking about as you implement this new standard. So in our example, we have a very simple operating lease, and let's say a nonprofit lessee agrees to make payments of $335,000 over the next 3 years. So hopefully these are some nice digs. $100,000 in year 1, $110,000, and then $125,000 in year 3. That's going to be our payment stream. Thank you. And so the underlying agreement does meet the definition of a lease. So remember, it's where we start. We meet the definition. We have specified asset. We have control. We get the benefits. We're going to just say that the appropriate discount rate is 5.5, and we got that because that's our incremental rate. We called our friendly banker. We said, hey, if I was going to borrow money today on a collateralized basis for the term of this lease, which is 3 years, what would you charge me, banker? And the banker says 5.5%. I said, great, and that's what I'm going to use. Or I can just use the risk-free interest rate, my choice. And then we have an extension in this lease. We have an option to extend in this lease, but we don't think it's reasonably certain that we're going to extend. The world's crazy 3 years from now. I don't know. I might be bigger. I might be smaller. I need the flexibility. I don't know if I'm going to want to extend this thing or not. So I'm not going to include that. I'm not reasonably certain. And then I run my calculator, and my calculator tells me the present value of those future lease payments discounted back at 5.5% is $300,000. So that is the present value of my future lease payments. And so, voila, we get a journal entry based off of that. So we have a right of use asset, and the right of use asset is that $300,000. That is the present value of the future lease payments. And the liability side, we actually have to split out between the current piece, that's what we're going to pay in the next 12 months, and the long-term piece that's going to be paid after the first 12 months. Again, look at this journal entry. Remember that ROU asset is a long-term asset. So again, look what this just did to your current ratio, right? You just dumped 90 grand of current liabilities onto your balance sheet with 0 current assets. So you just hurt your current ratio. So that's kind of a bummer, but that's your opening journal entry. That's what's going to be on your books. Okay, so the first year, here's the journal entries that you're going to book for the first 3 years to record the passage of time and the use of the asset. So there's 3 of them. There's 3 journal entries that we've got to book. Okay, the first one is real simple. This is just our cash lease payment. We said earlier the first year lease payment's $100,000. So boom, our cash is gone and we're going to reduce our lease liability. Okay? The other thing we have to do is we have to accrete the lease liability, right? Because a year went by, so the lease is a year closer to expiration, so I've got to recognize some interest expense. So I'm going to debit my interest expense bucket and I'm going to credit the lease liability, in this case, call it $15,000. Journal entry number 3 is to deal with the asset that's on our books. So I have to amortize that asset. And I'm going to amortize it, in this case, at $95,000. That's a debit to expense. And again, credit the asset or credit the accumulated amortization account, just like you would a fixed asset. Now, the interesting thing with the journal entry number 3, we're so used to straight line depreciation with assets, right? That's not what we're doing with this ROU asset. The ROU asset, the amortization we're going to record, the standard didn't like to use the word plug. But they use the term, it's a balancing figure. So it's a balancing figure because it has to equal what our straight line expense is going to be. Because remember what I said at the beginning, that your expense is going to be the same? So we're going to take the interest expense number and we're going to subtract what the straight line lease payment is, and that's going to be the plug to the amortization of the asset. Okay, so it's a little bit funky. Again, another sham in 842. The amortization of the ROU asset, because the interest expense is going to shrink, right? As we get closer to the maturity date of the lease, interest gets lower and lower and lower. And if the lease is going to be straight line expense, that number on the ROU asset's got to go up, up, and up, because lease expense is going down, so amortization expense has to go up to equal the straight line rent, right? So does it make sense that you have an asset that is actually going to be increasing in amortization expense every year? It's a wasting asset. It should be getting worse, yet our amortization expense is going to get higher. Year 3 amortization expense will be higher than year 1 amortization expense. Doesn't really make any sense. But the standard is willing to overlook that. The great thing is for years 2 and 3, you're going to book the same 3 journal entries. Same 3 journal entries in year 2 and 3, just with updated numbers. And really, it's that simple. The income statement effect, if you figure out all the math, it's the straight line expense. It's the $335 grand that we're paying divided by 3 years. That's about $111,000. So again, straight line expense. And as I said, in the old days, we just have lease expense, and it would be in this case, the straight line $111,000. Under the new standard, it might help to think about it that part of it is interest expense based on that lease liability. Part of it is amortization of the ROU asset. But again, the total amount in the income statement is the same. So we're almost at our time here, and I have 2 more slides. And this slide here is PricewaterhouseCoopers, which is a Big 4 firm. They actually did a really nice survey of 200 public companies, and they said, what were the top 3 mistakes that you made on implementation? And so I put a slide in on that. You can find that report on the internet if you're interested to read it. But again, I don't know that there's anything too startling in there. And then the last item that I've placed in the agenda is just a little checklist about some things you should be thinking through and process as you go through. Because this really is going to be a change in your company. You are going to need some new processes to deal with this and maintain it and update these lease numbers, because now, again, they're in your financials, they're on your balance sheet. So you're going to have to care a little bit more about them now. They're not just buried in a footnote at the end.